Something you'll constantly hear is only trade liquid stocks. What does that mean and why is it important? That's in today's video. Hey everyone, lead trainer with StocksToTrade, Tim Bohen, back with you here. Be sure to subscribe to our channel and also definitely make sure to ring that bell. We do a lot of videos every week, including live videos, and I want you to be notified instantly when they hit. So today we're going to talk about liquidity. What is that? Why does it matter? And why should you be concerned with it? Okay, so you'll hear it all the time. Only trade liquid stocks, only trade liquid stocks. I'm going to give you a couple criteria that you should look for, and these are criteria you should be plugging in to your scanners, your screeners. Hopefully you're using StocksToTrade. Obviously I'm a little biased, but maybe you're using a web app or maybe you're using some other application to do this. These are all parameters you should be plugging in. So when it comes to day trading particularly, that's what I'm going to focus on today. If you're talking about swing trading or investing, you can lower these levels a little bit, but when it comes to day trading, you never want to look at a stock that isn't trading 1 million shares a day or projected to trade 1 million shares a day. What do I mean by projected? You know, if you're looking at a stock in pre-market, so say it's 9:15 and this stock is up big, it has news and you're interested in it, but if it's only traded 1,000 shares, maybe it's even into the market open, and the stock is only traded 20,000 shares, 30,000 shares, it's very unlikely that this stock is going to hit your volume forecast of 1 million shares a day. So what you want to be doing in pre-market, and you can manipulate this number as you move through pre-market. So pre-market for NASDAQs and NYSEs start at 4 a.m. You can start looking at stocks then, probably not going to be a whole lot moving, but come 7 a.m., 8 a.m., this is what I want you plugging in your screeners, 50,000 shares. If it's not trading that, I don't care what the news is, I don't care what the catalyst is, it's not on your radar yet. Then as you move into the market open, after 9 a.m. into the market open, you should really be at that point where it's 1 million shares traded a day already. I know that sounds like a lot, but as a newer or intermediate trader, you only want to be trading the stocks that have the biggest potential to move. You got a small account, you're trying to grow it, you're trading illiquid stocks, you're going to get in a tough spot. Now, maybe some days there is no big mover that's traded 1 million shares at the market open. Good. Okay, you're probably under the PDT, you've probably got other commitments, day job, school, family, whatever. If you don't have that really liquid stock at or around the market open, if there's nothing on your scans, it's a good day to take care of other priorities or save those day trades. Now why is this so important? The biggest reason is what makes stocks moves. Why do stocks make the big gains? It is because it's a marketplace. It's because there's more buyers than sellers. We're talking about going long in this particular instance. You want that mania. Back to, I reference this all the time, but back to that, every Wall Street video you'll see of the guys with the multicolored jackets yelling, screaming, throwing the tickets. That's what you want in day trading, because more buying creates those big moves to the upside. So that's why you care about liquidity. More eyes, more buyers, more traders heightens the potential that this stock's going to spike at the open, going to spike midday, and then maybe spike into the close and maybe even be a multi-day mover. More buyers means higher odds of a continued move. Low volume, if you've tried buying morning spikers and maybe you tried it a few times and none of them worked for you, go back and look at what the volume was. Because if the volume's not there to support that morning spiker, you're probably going to buy one of those ones that fails. That's why liquidity is so important and volume is so important. The other reason, and this is the last point, keep in mind, if you're in a very illiquid stock, you can have real problems getting out. It's called slippage, okay? If this is an illiquid stock with a wide bid and ask, and these are things we talk about in a lot of videos if I'm throwing jargon at you, but if you got a wide spread on a stock that's illiquid, you may want to sell on the ask, But you can't because there's no bidders that are willing to come up and take your offer. So you got to sell on the bid. And if that's 50 cents a share lower than what you're in at, think about what happened to your profits. You could be up on this position nicely, but if it's illiquid, you can't get out. If you can't sell, if you can't get a buyer to buy your shares, you got to start dropping your price. And I call that, you're basically trading against yourself. Because you got to lower that price because you want to take profits, you want to get out, maybe you want to buy another stock, maybe you want to be in cash for the night. I've been there. It stinks. It's a bad position to be up nicely but not able to get out. So keep that in mind. Write down these numbers, put them in your scanners, and please, the one big thing, avoid stocks that don't have the volume forecast to potentially trade 1 million shares a day. Thanks a lot, everyone, and we'll see you in the next video. Thanks for watching our video. Be sure to comment below with any trading related question. We love answering your questions. Also, like and share with your friends, and be sure to subscribe to be notified as soon as our next video hits. And if you're looking to expand your trading knowledge, don't forget to check out all of our other videos, and be sure to click the trial below. Check out StocksToTrade. I think it is one of the best, most rapidly advancing softwares out there. Be sure to check out our trial.